This is a Momentum Media production.
Welcome to the Smart Property Investment Show, the podcast by investors for investors.
Okay, how you going? Phil Tarrant, host of the Smart Property Investment Show. A few shout outs. I know someone that's driving up the north coast of Australia at the moment on his regular annual fishing trip, and he sent me a text over the weekend saying that he was spending the time tuning in to the Smart Property Investment Show. So the points for effort there, that's a lot of time listening to me, and you must have fallen asleep at many points in time. So hopefully, I know you're up there for a little while fishing on your drive home, that there's a whole bunch of new episodes for you there to tune into on the way home. And it's funny, the breadth of people that tune into this podcast, people from all walks of life, but the commonality is that they're all interested in or have embarked on a process and a journey, if you want to call it that, to investing in property, the purpose of which largely is to give them choice later on in life when they may not want to work as hard as what they do right now. And this particular person I'm thinking about works really hard. He's been working hard since he was about 16 years old as an electrician, and I think he would love to retire with a large property portfolio, which means he would never have to pick up a pair of pliers again. So that's one version of the story of property investment, and everyone is unique in their own way, going about doing what they're doing. Hence the reason why surrounding yourself with the right people is absolutely critical when you're investing in property. Not one plan fits all. It's like a piece of DNA. It's unique to each individual person or a fingerprint. You need to make sure you're doing the right thing at the right time in your property investing career to make sure you're getting the right outcome. Fortunately, we have a lot of good and growing skilled operators in Australia who are supporting this particular cohort, this industry sector. Property investment is still an unregulated industry in terms of advice. A lot of work's going on behind the scenes to try and maneuver towards some sort of universal regulation around it. It's really hard with insurances and all this sort of stuff. One body in particular, PIPA, Property Investment Professionals Australia, are doing a lot of work to that, which is pretty important. But you need to use your common sense, your judgment around the people who you choose to use. We like to showcase those operators out there who are doing good jobs through our awards programs and other things, including this podcast, which is great, and we'll continue to do it. One of them is InvestorKit, who won Buyer's Agency of the Year at the 2024 REB Awards a little bit earlier this year in February, I think it was, by memory. Most of you would know Adrian Lee. You pick up your social media feed, he's probably on there somewhere, very data-driven buyer's agent. And we like bringing Adrian into the studio. He comes on quite regularly to have a bit of a yarn, and I pick his brains, and he's very forthcoming in sharing his research and insights. So thanks for that, Arjun. But today, rather than getting Arjun in the studio, I've probably got someone that does more of the work at InvestorKit. And this is what I'm seeing more and more when I scratch the surface on InvestorKit. There's a whole bunch of people behind the scenes who do a lot of the heavy lifting. A lot of it comes through Arjun. You'll see him very visibly doing a lot of that work. And he'll be the first to say that his success is certainly the success of his team. So if you're tuning into this, Arjun, I know that's important to you. But today, joining me in the studio, one of your key team members, Adrian Lee, who is a portfolio strategist. I've asked him to come in the studio to give a sense around portfolio planning and the importance of portfolio planning, and trying to get a sense for how Arjun runs his business in InvestorKit. All buyers agents do things slightly differently. Different people do different things as part of the process. InvestorKit has a particular way of doing it. I know they all share a back end of data capabilities and research capability, which a lot of their buyers agents draw into. From what I understand, those buyers agents also draw into very capable people doing portfolio planning prior to asset selection. I'm going to chat about that today with Adrian. Also learn a little bit more about him. Adrian, how you going? Welcome to the podcast.
I'm good, thank you. Thanks for having me, Phil.
So you're not Sydney-based, you're Melbourne-based, always been Melbourne, born and bred?
Yeah, born and bred in Melbourne. So come to Sydney a decent amount of times, but yeah.
Yeah, so you come up to see the team, or for R&R, or you're still investing in property, or all of the above?
Yeah, pretty much all the above. We have team events and things like that, which is probably why I frequent Sydney a lot more recently, but yeah.
Yeah. Well, there's been a lot of events. I think I saw you. Did I see you at the REB Awards? Were you there?
Not at the REB Awards. I was actually overseas at that
were
time.
you?
Yeah.
Okay. Holidays. You get lots of holidays?
Yeah,
that's pretty cool.
We have the remote working policy, so taking the most of that. Yeah.
Oh, right. So you can work anywhere, really, as long as you're doing the job at the right time.
Yep, exactly right.
Pretty chilled and relaxed. Very modern way of doing things. But I note that I sort of mentioned really quickly, PIPA, the Property Investment Professionals Australia. I sat on that board for many years. I no longer do that. I've handed that baton to some other very capable people on it. But you're a qualified property investment advisor. That's part of PIPA. So you did the course, did you?
Yeah. I did the full course. I got that. That was last year. Yeah, just after I started.
How did you find it? Because I remember like 10 years ago, I got all the course material. I was going to sort of do it. I was like, do I need to do it? I went, I may as well do it. And I started doing it and I just didn't. It's quite a lot of work, right?
There's a lot in there. Yeah, it's quite interesting in terms of all of the content, and there was definitely some things that I learned from that process. But yeah, there's a lot to get through, a lot of tests and assignments, and the main big assignment, which was actually quite good because it kind of gave you a feel of actually building a plan as well as communicating it to a client who would have follow-up questions and question you about certain parts of the plan. So yeah.
And that's pretty much what your day job is now, right? That's what you do.
Essentially,
that's what you do.
Yeah.
So it's called a QPIA, Qualified Property Investment Advisor. So a worthwhile exercise.
Yeah, absolutely. Yeah. In terms of if you are looking to be in the sort of, I'd probably say a little bit of a more niche role in the buyer's agent space of being on the strategy side and building out plans. Yeah, definitely worth it.
So a lot of people would do all of it. Then some organisations, they compartmentalise it. And it sounds like that's how InvestorKit has it structured. So you just do portfolio planning for people in construction, and then someone else does the asset selection, the tactical part of it.
Yeah, absolutely. Yeah. So look, we have a buyer's agent team where we're working closely with, but in terms of, let's call it specialising in certain divisions, my specialty will be portfolio strategy on building plans, making sure that we're making the right moves. And then when it comes to us ultimately looking for the right property, that's when we go to the buyer's agent team and work with them and go, hey, this is exactly what we're looking for. Please help.
How do you actually work, like, and we'll get into it today, but sort of top line, like when you're planning from a mindset point of view, you know, one of the key things is not having a bias towards this is the outcome you're going to get, and therefore you're going to create a portfolio plan that supports that outcome you want. You actually go in there without any bias or any sort of perceived recommendations and go through the rigor and process of really unpacking it to determine what the tactical next steps are. Like, that's a tough thing to do when you do it a lot of the times where you just think, well, I know this is where it's going to end up, so we can get to that a lot quicker rather than going through the motions. How do you keep a balance on that?
I'd say when it comes to planning, it's very much looking at their situation and going, hey, look, what would be the best thing or best property or best asset or best outcome for them? And then we can reverse the process rather than going, hey, look, we've got this asset ready to go. Let's say, you know, if we had this brand new place that we were looking to sell in another scenario, we're doing it the other way where we're going, hey, this is exactly what we need in terms of criteria, in terms of price point, in terms of yield, and all of these other sort of metrics that we would look at and go, cool, this is exactly what we need. Let's go get the team to find this exact asset that would be perfect for their portfolio.
And it's a really good way to view it because a lot of people sort of aren't really able to delineate between goals and objectives and strategy and tactics and all that sort of stuff. But structurally, that's how you do it. So you do the strategy work and then someone will do the execution work.
Yeah. That's exactly right.
Do you feel like you're missing out the fun bit, inverted commas, of you know, finding the properties, or you're quite happy sort of more in the background? You haven't got the high profile sort of glory job, right? Like, you know, you're not going to get a pat on the back saying, oh, your strategy was excellent. It's going to be, oh, that property was excellent.
Yeah, for sure. I think, look, the exciting part when you're purchasing or going through the journey is probably those really big milestones of when you get the contract locked in, when you secure the property, when you settle. Those are those really big, exciting moments. But I think for me personally, I very much like the sort of strategic thinking of that high level, taking a step back. Hey, this is looking at your portfolio. This is looking at where you want to go from that very high level perspective and seeing those numbers and planning everything out. Whereas when it gets into the details of purchasing the property and things like that, I'm happy to leave that to the buyer's agent who are much better at it.
That's cool. You need to know where your skill sets is. And you haven't always been a portfolio strategist. You've had a job beforehand, and no doubt it was probably quite an analytical job. But what were you doing before you were doing property plans?
Yeah, so before this, I was in a bit of a different field where I was working in management consulting. So it's very similar when it comes to thinking about strategy, thinking about that high level thinking of, taking a step back and big picture thinking of where do we want to go? How do we get there? What are the steps involved? So basically the same thing, just thinking more for, I guess, businesses in their business and tech operations and strategy rather than property.
You spend most people go management consultant. I have no idea what a management consultant does. They just go, what? Like
Most people don't. Yeah. It's, how do I say? Thinking about helping businesses operate and thinking about their strategy essentially and everything involved with that. It's a very blurry kind of title as well as job description because it can change every day. Yeah.
Same but different, I guess, than the work you're doing right now. And you're a property investor yourself though?
Yeah. I've been a property investor for a while. So that's sort of what.
Tell us about your own portfolio.
Yeah. I mean, what kind of details would you like to know?
I don't know. When did you start investing? Sort of give me a sense for the size of it.
Yeah. So I started investing in 2021.
Okay.
It's not a massive portfolio. I've got 3 properties at the moment. So I've sort of, gone through a couple of years of investing, understanding, spent a lot of time researching and learning, especially. When I started, I'd probably say I didn't really know too much. And then it came, I think, from, as it does for most people, a bit of an obsession where I spent a lot of time researching online, listening to, obviously, the podcasts, reading books, going through all of the millions and millions of content that InvestorKit also puts out, and I followed them for quite a decent amount of time before I joined them as well. So, that was sort of how I got into property as a career. But in terms of investing, got 3 properties, hoping to go for a 4th, hopefully soon.
Are you still as obsessed on your personal portfolio now that you do sort of portfolio planning every single day? Do you sort of go, I don't want to do it when I get home from work?
I think I don't think about it as much for myself now. I'm very much more thinking about it for a lot more of my clients and going, hey, all of these things, how do I factor it in for them? Whereas for myself, I mean, fun recent story is the last property I purchased, I looked at it for an hour before I said yes. So I don't think about it too much from my personal side. I think it's usually more focused on the clients and thinking about it.
And if you immerse yourself in property every single day, you're going to be a lot more confident to make quick decisions.
Yeah, exactly. I know what the team does and I know I'm confident in their abilities and everything they purchase. So when it came to the last one, I was like, I trust you guys.
And what's your sort of what's your overall goals or ambitions as a property investor? Like, what's that look like for you?
It's an interesting question. I think for me, I don't really have a very hard goal, if that makes sense.
It's okay.
Yeah. I think for me, it has changed over the years. I think previously when I was in a career that maybe I admit that I wasn't as excited about, it was very much thinking about passive income, thinking about that early retirement sort of goal. Whereas now, that's not too much of a concern. I really love what I do and I'm passionate about it. So now it's more just, hey, look, having that sort of fallback in terms of my portfolio, making sure that that's growing in the background so that if there is a sort of rainy day, I can rely on that.
We're still relatively young. You're not that old, so you got a lot of time. And some people get obsessed with goal setting and planning and, they'll start this journey and make it like this perfect plan. It's like you probably haven't had children, but like they create a birthing plan. Birthing plans don't last at all. It's always the opposite of what happens. And the same thing happens with property investment. It's okay to have a vague sort of plan. You don't need to say at the start of your property investing career, I want to retire with X number of dollars of passive income, because I tell you, when you start investing in property, your plans will change.
Yeah,
absolutely. So you need to be quite fluid and pragmatic in the way in which your planning complements changes to your ability to invest in property, right? And no doubt your portfolio planning is connected in with that. So it's a really important mindset. But are you going to buy again soon? Is there anything on the horizon for you?
Hopefully end of year. We'll see how. There's a couple of things that are changing. Obviously, we're in the 2nd of July now, so the tax cuts have kind of happened and that'll create some changes as well. But hopefully to securing something by the end of the year, which will be nice.
I spoke to my broker a little bit earlier today and they said that a lot of people who have been waiting for these tax cuts come in thinking that they're going to have greater serviceability. The bank's essentially just assuming that people are going to spend it. So it's not going to change your serviceability at all. So anyway.
I got some emails from a broker saying with some very impressive numbers that they were saying that it has sort of stretched to. So it'll be interesting to see.
I'm sure there's different lenders will view it differently, but even at 100, I think at 100 grand, if you're $100 grand salary, then you get about another $3 grand a year in sort of tax. That's most lenders are just going, you're just going to spend it. So anyway, maybe discuss for another day. I just want to get sort of in the meat of strategizing around building a portfolio and when's the right time to do it. And, importantly, don't start without a plan, a portfolio plan. We'll get into it. We'll just go to a quick break. Stay with us, back in a moment. Welcome back. Phil Tarrant for Smart Property Investment. Welcome back to the show, smartpropertyinvestment.com.au. And please, everyone, keep those reviews coming wherever you're tuning into this particular podcast. We do get a kick out of it. It's nice to know we're doing good stuff. I get a lot of anecdotal feedback when I'm out and about and people say we're doing a good job. But if you can do me a favor and just leave some of those reviews wherever you tune into your podcast. I do it for other podcasts that I listen to. I must admit I don't listen to that many more property podcasts. Occasionally I will do. See what other people are doing and to get a sense for what's happening. But it's always nice to show your appreciation if you don't mind. Now, Adrian, don't start without a portfolio plan. Well, let's go to basics. What is a portfolio plan and what's it made up of?
Yeah, so I'd say, look, a portfolio plan is essentially a tool that identifies three key things. Firstly, where you are now, where you want to be, and lastly, I guess the steps that you need to take to get to your goal. So look, in terms of first steps, first thing we do is do a deep dive into the data of the client's current financials, the high-level financial details in their current portfolio, just to give us real clarity around, hey, this is where you are now. And then the second part is mainly just us understanding what is their goal. It's a bit funny I say this because, as we said before, I don't really have a clear goal, but usually what we want to do is really question the client and understand what is their goal, where are we trying to get to. This might not always be the numbers that we're talking about of 7 properties or this number of passive income. We also try and think of it on a conceptual level of, hey, what would your lifestyle be like in this sort of dream scenario in terms of your goal? And then lastly, potentially more importantly, it's about the steps that we need to take to get there. What are each of those individual steps of how we plan out your portfolio, every single move that we need to take, making sure that we're making the right moves and building that pathway of getting you from where you are now to that sort of future goal.
Yeah, and that's important, and a big part of portfolio planning, part of it is what is your objective, but it's okay, I feel, that your objective can be a little bit vague. To your point, I'd certainly put myself in the same bucket. Like, my objective is to invest in property for the purpose of creating wealth.
Mm-hmm. Yeah.
To build a portfolio as large as possible, it costs me as little as possible to hold, and for it to go up in capital value, so the right asset, right selection, right? Like, that's a big part of portfolio plan. So it's okay for your objectives to be more sort of conceptual rather than detailed. Like, I need 7 properties that's returning me this. Like, I don't know how many investors start out with those sort of that's sort of that's a mid-tier, mid sort of experienced investor where they start thinking about and they see the practical application of investing in property. They can start thinking in those terms. Like, there's not many initial investors where they've actually thought about it. No doubt it's your job as a portfolio strategist to try and extrapolate that information. So you just ask a lot of questions, I would imagine.
Yeah, absolutely. I think when we're doing our strategy sessions, a lot of the sessions can get quite deep in terms of thinking about what they want out of their lifestyle. And then from that concept, that's where we base out the numbers. We go, cool, if this is what you want in your lifestyle and how you want to live and what that involves, we can sort of figure out some numbers and go, okay, cool, this is probably what we need to aim for. And like you said, it doesn't have to be a hard goal. It's always going to be rough. I can't exactly calculate to the dollar, hey, this is exactly how much you will need to live that lifestyle. But once we have that sort of rough number, we can base our plan off that and go, this is where we roughly want to end up. And then naturally, as you said, plans evolve, plans change. There's always going to be changes where that'll change.
So you're mainly an interpreter then. People tell you what they want and then you interpret that into, steps and a sequence for people to actually go down that pathway. The pathway may change where they end up, but you've got to interpret that and turn it into something which is factual, because a lot of people wouldn't be thinking under this many properties generating this income at this yield level, right? So that very much is the job.
Yeah. I'd say a lot of the job involves asking the right questions, because if you're sitting by yourself as someone who hasn't really invested, hasn't built a portfolio, or doesn't really understand the numbers, you probably won't really know the exact questions to ask yourself of what you exactly need. So it comes down to asking the right questions and then interpreting that and going, this is what you need. This is how we sort of get there with property with these numbers.
So you ask a series of cascading questions that helps you extrapolate from a client the information you need in order to put together an appropriate plan.
Yeah,
okay.
Right.
All right. So I'll try and simplify things. Really important. So why shouldn't people invest without a plan? Like, do you have to do this to be effective?
You added that last part to be effective, and that threw me off. But look, I think it can be a little bit dangerous to invest without a plan. Yeah. And the thing I'll commonly say is, look, if you don't know where you're going, how do you know if you're taking a step in the right direction? One thing that can be sort of thought about is, look, you can make a lot of moves, you can make a lot of purchases and do a lot of things within property, and you might be running really fast, but if you're running in circles, are you really going anywhere? And that's why I think it's quite important to start with that plan, because we want to make sure that we're making the right moves when it comes to property. Each decision that you make carries a lot of weight, and it can be very, very costly if you do make the wrong move, and it's pretty easy to make mistakes as well. Yeah. You can buy the wrong type of asset, you can purchase the right type of asset that performs well on paper, but it might not be right for your portfolio. Or maybe you purchase the perfect asset for your portfolio, but it's in the wrong structure, and that kind of sets you back as well.
And it's only when you sort of work out that it's a mistake, it's too late. Like buy stuff, like I was only chatting today with someone, and they're going through a process now of reorganising the structure of their portfolio because things aren't in the right entities. And you hear this all the time. A lot of people are accidental investors where their principal place of residence becomes their first investment property. Might not necessarily be the right investment property as part of your portfolio planning, but you're not going to know that. You might not ever know that because that might be your only investment property ever, because you can't actually, because you've gone out and bought another principal place of residence and you can't buy any more property, right? So those people are probably blind to it and they don't know. It's only when you sort of scratch the surface and start thinking about investing in property that you can realise that things aren't perfect. And most people's portfolio is not perfect by any means.
Of course.
But a plan probably helps you sort of move towards imperfect action, right?
Yeah, exactly right. Like you said, it can be very costly. I mean, if you're, like you said, with your friend, if they're sort of reorganising their portfolio, there's probably multiple sales and repurchases that they have to do. But I think, that's usually the biggest mistake and where the biggest costs come from. If we're talking, let's say as an example of a 750K property, nothing too cheap, nothing too expensive, somewhere mid-range, you've got 6% acquisition costs, you've got 3% selling costs, you've potentially got a buyer's agent fee as well as any tax. So let's call it easily 10%. That'll cost you 75K just to change the asset over to purchase something. So it can be very costly, and you can easily see how that wipes out 1 or 2 years of your returns if you do have to potentially sell.
So in a perfect setting, you'd like to get your hands on someone's portfolio when it's at zero, because then you can craft a plan without having to remediate or ameliorate any issues that are problems inside the portfolio already. That's a perfect world, but I doubt you get too many perfect clients.
Yeah, that's ideal if we can start off their portfolio right. And we do get a few clients who are starting with us and we go, awesome, we can start off fresh. We can make sure that they're making all of the right moves. And then there'll be other situations where people come to us and they've already got a portfolio, or pretty commonly, they're an accidental investor. They purchased their home, they've upgraded, and then they've got this asset as an investment that they have in their portfolio, and it could be multiple years that they've had it before.
Yeah. So you must have done hundreds of these things now. Do you still enjoy doing them at the same speed, as the same rate as what you used to?
Yeah. Look, I think I enjoy it every time. It's always a little bit different with each person. You get to learn a little bit about them, what they want to achieve, their portfolio, and there's always sort of minor tweaks. But yeah, I still really enjoy doing them every day.
Can you feel yourself getting better at doing it? You must do. Like the more you do something, the better you should get at it. But can you actually, do you have a sense for where you're improving doing it? Is it the way in which you engage and connect with people to extrapolate information, or is how you use that information, or both?
I'd probably say both. Yeah. There's the first part where it's getting out the information from the client, and the more you do it, the more you understand the questions that you have to ask the client to really get that information rather than sort of dancing around it. And then the second part is when you build these plans and you build these strategies, a lot of them are very unique in terms that they all will have minor tweaks and minor sort of nuances to each plan. But at the same time, there are patterns that you can kind of see. And the more you do them, you understand these patterns and you go, okay, I've seen this one before. This is what I did last time. I can probably do a similar thing, but tweak it slightly.
Tweak it here and there. And that's important. That's that shared experience, right? And your exposure to different ways of investing. Like, there is a uniqueness with everyone, but there is going to be certain similarities which you're going to be able to spot pretty early on. And, no one is that unique. You probably fall into certain buckets, but there's going to be uniquenesses within those buckets. So what would be the 3 biggest learnings that you've had so far building out sort of portfolio plans for people?
Look, I think the first thing is probably all around cash flows. Cash flows are very important because if clients don't really have a good wrap around their personal finances, it's very hard for us to get a very robust understanding of the entire situation. So we want to make sure that when it comes to cash flows, everything's being measured. And I'm not talking about every single transaction that we need to track and going, hey, make sure you understand.
Is it personal cash flows or the cash flows of your property portfolio, or both?
Probably be both. We can help a lot more with the property cash flows because we have all of our modeling and numbers and things that we can break down. But when it comes to personal, that's obviously a little bit stepping over into financial planning or, their personal side where they need to do it themselves. So making sure they just have a really clear understanding of at least the 3 kind of buckets, what they're earning, what they're spending, as well as what they're saving every month. And then from there, we can take those numbers and then take it to our side and go, hey, these are the numbers for the property, marry them up, and we can understand and get a good understanding of, hey, if we were to expand the portfolio, if we were to do this move or that move, what does it actually look like to your cash flows? Is this a potential risk or is this something that you should be comfortable with?
So cash flow being a key learning, what else have you sort of picked up through doing many of these?
Yeah, I'd say the other second biggest learning is probably that a lot of these people come here and regret not coming to us earlier or doing a plan earlier or purchasing earlier. There's always going to be a reason in terms of why someone has stopped themselves from investing or they've gone and talked to us and gone, hey man, I should have really done this, had this conversation 5-10 years ago. And that's a common thing across the board. Even for myself, I'd probably say I started early, but did I push as hard as I could have? Maybe not. And if I had someone really taking me through the details of the numbers, it would have been useful because then I would have understood, actually, maybe I couldn't have gone a little bit further than where I am right now. So oftentimes it might not actually be the finances that are holding back an investor from purchasing. Usually it's the lack of knowledge or the lack of confidence, and that just comes where we need to educate clients. We need to really drill down and give them that confidence in terms of transparently, like you said, kind of translating everything and going from all of this noise of them investing to, hey, this is what it actually looks like in a worst case scenario. And then usually they realize a couple of things. Firstly, the downside risk isn't actually not that scary. It's not as bad if we even project out these worst case scenarios. Second part is the opportunity cost can be huge. I think we've seen that in the past couple of years where a lot of people have made quite life-changing returns in the past few years and everything that's happened now. I can't guarantee that's going to happen going forward, but I still think that we have a couple strong years of returns and, if we are delaying, that can cause some serious consequences.
So biggest learning, do it early and do as much as you can. I'd absolutely fall in that bucket. I started reasonably early investing in property, probably comparative to other people I would have been, sort of early-ish 30s. I wish I started when I was 25, but I wouldn't swap for a moment what I was doing in my 20s for having a nice big fat portfolio versus not doing that in my 20s and starting in my 30s. And this is horses for courses, right? Like do what you want to do. But I completely agree. One of the key learnings is start early and go as hard as you can. I haven't gone not hard. I've got sort of quite a large sort of portfolio. And this is the interesting point. It gives you a certain sort of perspective on stuff when you can sort of look at how other people are doing stuff and try and emulate it. But one of the issues I have, I sort of doing this particular podcast, my perception towards some things sometimes is a bit skewed because I speak to people with 60, 70, 80 properties in a portfolio worth, tens and tens, if not hundreds of millions of dollars. And you think that's normal, right? Yeah. So I would sometimes have a bias to think, well, everyone's like that. Therefore, I would frame and shape a lot of my conversations around that. But the reality is that most property investors have small portfolios, 2, 3, 4 portfolios. Most have one between 1 and 2. Then you've got this cohort of sort of 2 to 3 to 4 portfolios. So, can you give me some sense whether, you've seen it? You don't need to have these massive portfolios to probably get the outcomes you want when you're doing a portfolio strategy. You must see that all the time. You only probably need, you could probably get your goals with 3 to 4 properties. Yeah,
that's absolutely right. I think when I think about the hundreds of plans that I've sort of designed and created and also refined, all of these plans typically only need about 3 to 5 properties to really hit most people's goals. And a lot of people sort of advertise that going, hey, look, you need 10 properties. This is what you need. You need to buy one every single year. And it's just not the reality of the situation, where if you have 3 to 5, you get them paid off through any means. Yeah, we can usually hit most people's goals.
Yeah.
Even with very conservative assumptions that we use.
But do you find, though, that someone might go, you only need 4 properties paid off and that's going to be adequate for me to get the utility out of property investment as I want? I've never seen anyone get there and stop,
Yeah.
You know what I mean? But in order to have 4 properties paid off, you may need 8 properties, right? And then, have a decade or 2 of capital growth, sell off 4 and pay off the rest, right? That's one strategy.
Yeah, exactly right. So there's multiple avenues that you can use to get there, whether it's, this typical buy 8, sell 4, be a bit more of an active strategy, or maybe it's, hey, look, you've got a long time horizon. Maybe you just ride it out and slowly pay down your debt and be a little bit more passive. There's multiple things that you can use to get there. But, as an end result, it's not like you always need 10 properties and you always need to have this huge portfolio to get you that passive income.
Yeah,
Sometimes
it's nice when your portfolio. Well, it depends. You're going to have different parts of your portfolio. It depends if you're investing in trust or how you choose to organise it. You're going to have parts of your portfolio which are probably positively geared, positive cash flow, and there's going to be parts which are negative, right? It's nice when it all becomes positive, but I know every single person when their portfolio gets positive, they go, "Oh, probably need some more property," right?
Yeah.
And then this will be a time to sort of maybe revisit your plan. Do you do that? Maybe it's one of the learnings that you've seen. The ability to actually. You don't just get a plan and then put it in a drawer and forget about it. Like, it's supposed to be a living, breathing tool to help shape decision making, yes?
Yeah, absolutely. It's not like the old school plans that were 100 pages long and you get this nice little document at the start. It's very much a modular, evolving plan because, like you said, realistically, people's lives change. Portfolios also don't perform in this straight linear fashion. So there's always things that need to be updated. So at a minimum, we refresh plans annually.
Okay.
Even if there isn't really too much to change, things might actually track out pretty evenly where growth is average, your income growth is average, situation hasn't really changed, and then it's just a nice little quick catch up. But it's pretty common where we'll have catch ups a year or even earlier for a lot of our clients who are being a little bit more aggressive and want to make moves a bit quicker. And then we go, hey, look, all of these things have changed. Let's update all your details on the financial side. Here's how everything's going in terms of your portfolio. Give them all the research, the projections, and then we go, okay, even the goals, they can also change very rapidly as well. And then we have to sort of rejig and refresh the strategy as well.
So what does a plan look like? Like I think a lot of people are sitting and going, it's going to be this big, thick booklet that you're going to use to hold your door open. It's not like that, right? Something a little bit more friendly and usable and navigable, because it's supposed to be a tool. It's supposed to tell you what to do.
Yeah, absolutely. It's changed a lot in terms of that big document. As of now, we use sort of planning software where we're able to pretty much put in all the numbers. And like I said, it's very modular. So let's say one of the numbers change, we can just jump in, change the number, and then it'll spit out all the relevant outputs. So what it really is a big sort of summary of showing you everything that works in the background. These are usually the assumptions with capital growth, rental growth, wage growth, all of those assumptions that work in the back end. And then what it sort of spits out as an output is, firstly, what do the numbers look like in terms of projecting it out? Usually it's a 30-year projection, but sometimes people have shorter timelines of projecting out key numbers. Let's talk about your cash flows, your passive income, your equity position, your debt position, market value of your portfolio. So all of those really key numbers and where they sort of sit out across those 30 years as a nice, neat little graph. And then the other side to that is a bit of a summary of this is what we're doing in terms of moves. Maybe it's a purchase here. Maybe it's a little bit of a restructure here, selling this property here. So it gives you, firstly, the key numbers, and then secondly, the key steps and of what we're doing in the plan.
And it's a really important point in that a lot of people they think, I'll do the plan as part of the process. I just want to get to the buying of the properties bit, right? Mm-hmm. And that's okay. And sometimes you might get it right and get lucky, right? And I guess it's your perception again to the plan and what it's going to do for you. You should be able to crystallize it. There might be a lot of information that goes into a plan, but you should be able to have a plan on the page, right? Like you should be able to have a really simple summary that tells you what you need to do and when you need to do it. And so part of it's going to be conceptual and part of it's going to be technical. The best plans, the best plan in the world, but if you don't execute it well or execute it at all, the plan's worthless and it's not worth the paper it's written on, because if a plan doesn't actually help shape what you do and how you do it, it becomes absolutely irrelevant. Do you ever do plans for people and then nothing happens?
I think usually it might not be nothing happens. It's just that they delay a lot.
Yeah, for a whole bunch of different reasons.
Yeah, for various reasons, whether they're legitimate reasons or maybe not so legitimate. Yeah, it can vary a lot. And there can be, decent consequences with that. When we're always talking about plans, a lot of importance comes on having a very tight acquisition period. So not spreading your purchases over, let's call it, 10, 20 years and always constantly buying. It's, hey, let's have a very tight acquisition period. Let's purchase as aggressively as we can at the start, and then let your portfolio compound in terms of equity, in terms of rental growth, to give you the best opportunity, because the more time, usually the better when it comes to property.
Yeah, if you buy the right assets. And this is the point, there is specific phases in a real simple sense towards property planning. There's going to be an acquisition, there's going to be consolidation, there's going to be a sort of, a pay down type of frame where you draw down the equity or however you choose to realise that as part of it. I want to chat a little bit more about that. We'll just go to another break. Stay with us, back in a moment. Welcome back, Phil Tarrant, Smart Property Investment. I hope you're tuning in and enjoying our discussions. I've got InvestorKit's portfolio strategist in the studio, Adrian Lee, chatting about planning. I love planning, and the more that you're in and around property, the more you realise that planning is important, but you don't need to overcook your planning. This is the point. But you shouldn't sit there and go, I don't want to do a plan. It's going to take me days and days and days. A plan should be a practical tool that gives you the steps and the sequence for realising what your goals are. That's what a plan is. It's really, really simple. And if anyone tells you anything different, you got to question it, because that's what it is. It is a thing with a purpose, and that's to actually give you a sense for how you take action. Do a lot of people get sort of a bit humdrum when they see a plan that says, I spend 4 or 5 years doing some really active stuff and then I do nothing? No, that doesn't sound exciting. Or, that's going to take forever to actually wait. I've got to wait 20 years to actually see the realisation of this plan. Do they get demoralised by that, or is most people appreciate property as a long-term game?
I think there's probably two sides of who you talk to. There's the people who have been exposed to a lot of marketing where they're going, hey, look, let's achieve all of your goals and get that 100K, 200K passive income in 10 years. And then once they're faced with the realities of it, it can be a little bit misleading, and they go, oh, why is it taking so long? When in reality, look, I can flex numbers, I can make a nice model with all of these assumptions and make it look like it's going to be 10 years, when in reality it's not. So those are the people who are going, this takes a little bit longer. Yeah. Then you've got the other side who understand, hey, look, property is a long-term game. It's very likely that most plans that we do will fit within that 20 to 25 years. And they understand that it takes time. And yes, it might be a little bit boring after that acquisition period, but it also depends where you want to go to, because some people will have their goals set that they only need those 4 properties. We can purchase those, we can pay them down. It's a very passive strategy, and that achieves exactly what they want. Other people will have larger portfolios where we're really stretching it with different strategies, different structures and everything like that to really scale them. So it might not be a purchase in 5 years and then sit back and do nothing. It really depends on each person and what they want to achieve as well.
Yeah, I don't want to disappoint a lot of people, but I think 1/8 of all Australians invest in property or record some sort of property investment things on their tax returns. So most Australians don't invest in property. Okay?
Yeah.
Most Australians will need to rely on a government pension to some degree in their retirement, depending on when it is and when they start at work. They will have superannuation, which will go some way to supporting retirement, but most people will draw on some sort of government pension. And I find that most people who invest in property go, I don't want to do that. I actually want to sustain a particular lifestyle in my retirement, and therefore property is going to be one of those things. What I would say, it's really, really hard to generate $200,000 in passive income out of property. Like, people throw around these terms all the time. It's bloody hard to do, to pardon the French. 200 grand, if you've got no debt on any of these properties, you need a lot of property. You probably run the numbers for me. You need a lot of property to generate 200 grand after expenses, not account. So if they're debt free, there's still expenses connected with it. Like, you know, that's hard to achieve.
Yeah, it really is. I think when we think about property, something that probably has been a big realization is that, look, property is great in terms of leveraging, in terms of building an equity base, but when it comes to the later stages, it might not actually be the best in terms of passive income. If we're talking 4% yields, and these are gross yields, once we minus, like you said, the expenses, maybe they cost 1 to 1.5%. they shave off that yield. You jump down to 2.5%, 3% net yields, and it's not very impressive when we compare
right
it
now,
to
you'd be
other
better
things.
having your money in a cash account.
Yeah.
Like frankly.
Yeah, so you're absolutely right. It is very hard to draw a significant passive income from property. We, like you said, we really need to clear the debt through many avenues, whether that's passively paying it down, whether that's selling, to really get a strong passive income. And yeah, when 200K is not an easy target, especially if you're trying to do it in a very condensed timeline.
Yeah, in a very condensed timeline is very difficult. It means you need, it's achievable if you've got a huge amount of capital to invest,
Yep.
right? If you just buy unencumbered property from the get-go,
Yep.
you can achieve that. But how many investors do you work with that don't have debt?
I think they all do. I don't think I have one as of yet.
Yeah. You know, and they're probably quite relatively early in their investing career, but you know, a lot of people get absorbed and obsessed with this idea of whether it's 100 grand, 200, whatever the number is, of passive income. Like if you've got unencumbered property,
Yep.
and you're looking for yield and you're in a retirement phase, probably not the best place to have your dough, like, to be honest with you.
Yeah.
And the issue you have though is that a lot of people have this realization when they get towards the latter part of their property investing career, where they go, for me to actually realize the equity that I have in my property, I've got to have some sort of capital event. Capital event involves tax. So you got to pay to actually get that money out to put it somewhere else and maybe get a better yield out of it for the purpose of cash flow.
Yeah.
It's so this is the planning, right?
Yeah.
Everyone focuses on the acquisition. The most important part is the consolidation and the drawdown phase.
Yeah, exactly right. I think there's, the fun acquisition part where you're purchasing property. It's exciting. You get to make all of these purchases and it feels great. Once you start, you always want to go for another. But then there's also that second part that a lot of people don't think about of, hey, what is my exit strategy? How am I really going to crystallize all of these equity gains into a meaningful passive income stream that allows you to get to your goals? Because nowadays, we can't really live off pulling out equity constantly.
No. Well, you can do that for as long as you have a job, right? But if you get to a point where you're not earning a inverted commas thing, like your property, you can borrow money on the basis of the income you generate through investments. But if you don't have a job, banks sort of start going, I don't really want to lend your money, right?
Yeah. It's harder than ever now.
It's harder than ever. So, be careful what you wish for sometimes with property investment. Like a lot of people say, oh God, if you've got enough to actually generate the income you need to live properly, that's cool. But,
But like you said, it takes a lot. Like just running some numbers now, right? If we need 200K passive income, 2.5% net yields, I think that sits at about 8 mil unencumbered.
So $8 million unencumbered property generating you 1.5%.
2.5% net yields?
Net yield.
I think that's right.
Yeah.
Yeah.
That's just, that's quite a lot. So if you've got $16 million in property at a 50% OVR, you sell half of it, you pay down the other half. You've got $8 million of unencumbered property.
Yeah. I don't think many people get to that stage. It's not easy.
No, this is it. So I just wanted to put it in perspective for a lot of people. Like, 3 to 4 properties we'll paid down. We'll give you a nice bit of income. But you probably want to be hedging your bets also, looking at other asset classes, right? Property's great. I like property, but it's I've got to force myself to invest in other asset classes like equities and stuff.
Yeah,
but
sure.
I do. Commercial property again is a bit different, right? Do you do much commercial recommendations inside of portfolio construction?
Yeah, we do. Definitely a lot more now that we have a lot more clients who have built out that residential base, and then we're going, hey, look, maybe the next step is commercial. This is what we plan for. Usually, if we do want to dial up the passive income, that's where commercial comes in because we're talking net yields. But yeah, commercial is definitely becoming a lot of a bigger part of our business where we're seeing a lot more inquiry, especially with our clients who we've dealt with for a couple of years because they're getting to that stage where it makes sense for their portfolio.
That's a natural transition for a lot of people, and whether or not you can factor that in the front end with portfolio planning. But, I know a lot of investors, they get the 4, 5, 6 resi portfolios and they may be tapped out from borrowing anything further in their personal names, and they just start moving to trust-based borrowing, and then there'll be a point in time where they go, well, I need to chase some cash flow, right? And they'll move to commercial. But there's a bit of a misnomer that commercial property doesn't grow at the same speed as residential property. That's not the case. They pretty much grow maybe at different speeds, but, over an aggregated long-term period, commercial property performs well from a capital growth point of view.
Yeah, absolutely does. And when it comes to yields, when it comes to cash flows, look, it's all a balance as we sort of map out with our numbers. As you purchase more and more residential properties with rates where they are, it does get more and more expensive, and you do need that income to supplement it. So usually that's where commercial comes in, and works well with structures and things like that as well as we balance things out.
Yeah. What do you like most about your job, Adrian?
I think honestly, as much as I love the planning and strategy side of things, where I get to think about the numbers and map everything out, I think it truly is talking to people about their goals and understanding them as people and seeing where they want to go and how I can help to get them there. So, I think that's the best part, where I get to meet all of these new clients and learn about them, learn about what drives them, and get them closer to their goals.
Yeah, I guess what you do is, it's a positive thing, is that people want to come and talk to you. There'll be other professionals that they don't want to go and talk to. Like a lot of people don't want to go and talk to their doctor, for example. Whereas, coming to talk to you means that people are being proactive and they're invested. They're invested in the in some sort of outcome they're chasing. They might not necessarily know what that is, and it's your job to really, to the point being, try and translate that into something of action that they can use. I imagine you probably sit there, and a lot of people sit down and feel a lot happier with themselves by taking action, investing in property. It's a real driving force.
Yeah, I think in the initial sessions it's always fun because you get to meet them, you get to understand them, and they also have a bit of a reflection period as I question them of, this is actually what we're chasing, and they get that clarity, which makes them pretty happy. I think the second part is when we do our reviews. Usually,
and they're normally most people are happy. You guys buy pretty well, from what I understand.
Yeah, I think so. Yeah. So
they go, wow, really? I've made that much money? That's more than my annual salary.
Yeah. Usually the reviews are pretty fun because I get to sit there and go, hey, look, we've made you. This is how much we've made you. This is how your portfolio is tracking. We're smashing your goals in terms of the timeline that we projected out last time. This is what it was. This is what it's now. Look at the progress that we've made. So that can be really good. Just seeing them smile and seeing them go, awesome.
Which is cool. You must get a lot of satisfaction out of it. And I get that. A lot of buyer's agents and property strategists and portfolio strategists I speak to get a great kick out of the fact that they're, in many ways, changing people's lives. And for many people, whether it's relationships or their personal health and happiness is intrinsically connected with their sentiments towards their financial footprint and the integrity of that. So, if that's one thing you can help improve for people, the consequence of that outside of property can be considerable and significant. And for a lot of people, just having property as an asset class is something that they can help building towards a future. It's a great thing, but you've got to have a plan.
Yeah, absolutely. I think one thing that's important is that when you hit this 20, when you hit this 30-year goal, it's not going to be some big revolutionary change where you're suddenly happy. A lot of the times it's when we're going through and executing the plan, people can see the progress and you can sort of see their mindset shift of going, I'm making so much progress, I'm getting closer to my goal. And that reflects on their attitude and their mood and everything like that.
Look, one of the reasons why I do this podcast is help educate people. So they have, it might be a catalyst for them to start investing in property and start realising there is something else out there. And I know InvestorKit spends a lot of time and energy and effort on creating research and education for people in and around property, which I'm sure they can find on the InvestorKit website. I've had a look at it. It's pretty good stuff. So I would assume that people are more educated around property today than what they would be a decade ago. It's so much more accessible now. So therefore, I would assume that you don't get too many people sitting down with yourself or your colleagues with some pie in the sky idea of what properties are. Are most people's plans realistic, or most people's expectations around what property would do for them realistic? Could give me a sense for someone who was at one end so far off the mark in terms of what they could achieve versus at the other end of the spectrum what people think they can achieve. You must have seen both sides of it. Where people come and go, I just want to buy an investment property. You could probably look at their finances and go, mate, you should have 10. Does that happen?
It happens all the time.
Yeah.
I'd say, look, the majority, like you said, people are definitely more educated. There's no doubt that there's more content everywhere when it comes to podcasts, blogs, everything like that. We're not in the days where you have to buy the magazines and go through all of that. But at the same time, marketing is an interesting thing, and it can affect people's brains very differently, where they have these concepts of building these giant portfolios and that it's very possible. So sometimes there is a bit of realignment. I've had clients who come in and, they want to hit a 500K passive income in 10 years and they're a very average income earner. And I go, look, if you want to get to a portfolio that's, let's call it 10 times the size of a normal person, you probably have to work 20 times as hard because you have less time, which means you take less advantage of compounding. So there is a bit of an education piece for a lot of clients where we're going, hey, this is what it actually looks like in terms of your timelines. Yes, we are very conservative with our assumptions and our model, so it probably will be a little bit earlier, but I do like to paint that worst case scenario and go, this is actually what it looks like. And then maybe sometimes it also motivates them to work a bit harder as well there.
And it's a really important point in that because information is a lot more accessible for people these days around property investment, doesn't necessarily mean the information they're consuming is accurate. There's a huge amount of misinformation inside of property and property investment for the purpose of, whether they're deliberate and nefarious means that people are trying to take advantage of people. And there still are people out there, property brokers, who are target property investors to exploit them. There's deliberate disinformation out there where people deliberately put information in the market which is completely inaccurate, but people consume that information, assume that it's factual and evidence-based and realistic and achievable. Don't be one of those people. Property is easy, but it takes time. You need strategic patience for it to work well. So you've got to balance your expectations around the realities of investing in property and your own particular and personal circumstances. Everyone obviously has their own unique fingerprint when it comes to investing in property. So, you don't disappoint too many people, do you? When they come in and go, mate, you're never going to achieve that. Do you ever sit there and just go, how do you think this? And one of the biggest issues we have right now in the proliferation of property investment advisors and buyers agents and portfolio strategists, it's really, really good for the industry. I said it's not regulated yet, but there's some very good operators around there. And I certainly put InvestorKit into that bucket. The issue is, though, if the whole paradigm of evidence of success in property investment is at an individual property level, we bought this at this and it's worth this. If that's where property investors and professionals set out their unique points of difference or the USPs, that's a big issue for the industry. I think the uniqueness and the competitiveness and the skill set of buyers agents is doing what you do, and that is giving people realistic plans to help shape their decision-making moving forward. And you give them a plan and they can go and do it themselves, no doubt, I would imagine. So planning is absolutely critical. It's got to be smart planning.
Yeah. I think there's, like you said, there's two parts where you can measure success of the property, or you can also measure the success of the clients where they've built a portfolio of a sizable amount, hitting their goals. Like I said, if people are getting to commercial property, that's usually an indication that they've done all right in their residential journey and they're transitioning to that. And I think that's a big sign. Whereas when it comes to individual properties, yes, you might get that one good property that looks really good on paper, but does that one property get them to their goals? It's a bit of a different question.
And that shouldn't be a frame of reference to the point I'm making. You only ever hear about people's big wins at the racetrack. You only hear about people's big wins at the pokie machines, right? You only hear about the big wins of people and they publicise it when it comes to property. But there's a lot of bad ones out there.
Yeah, it's very easy.
Planning should help you avoid that.
Yeah.
That's cool. All right. I've enjoyed chatting, Adrian. You're back to Melbourne tonight?
Yeah. Back to it. Back to the grind.
Back to work?
Yeah, back to work after this.
Back to your spreadsheets?
Back to not so much spreadsheets anymore. No. We've got the nice little software.
That's
back
cool.
in the old days, it was the spreadsheets. But yeah, back to work. Got a few things to do. Exciting things happening in the business. So yeah, back to it.
And there's always stuff going on with InvestorKit. That's what I like to see. And in many ways, like some of the very good operators out there in that buyer's agency space, changing and shaping it. And again, it's a perception thing. If you tune in this podcast, you would think everyone uses a buyer's agent. They don't. It's still such a small industry sector. Buyer's agency, most people still invest alone and invest in isolation, and that's okay. It's cool. I do it. I've done both. I use buyer's agents. I do stuff myself. but that doesn't mean if you're doing it by yourself, you shouldn't have a plan. You only don't plan. You don't only have a plan if you use a buyer's agent. You should have a plan even if you don't. Would probably be the key point around it, and lots of tools around there. But if anyone wants to have a chat with you, Adrian, what's the best way to track you down? Just through InvestorKit?
Yeah, through InvestorKit. So I'd say if you're looking to inquire with InvestorKit, it's probably, we do strategy sessions for every single client before we onboard them and purchase for them. We're not, your usual buyer's agency that's just ticking boxes to purchase one and then the other. Everything's around creating goals, making sure that we're doing the right steps and buying properties that follow a plan to get them to their goals. So yeah, you can reach out to the team at investorkit.com.au for a free consultation, and yeah, that's the best way to get in contact.
All right, sounds good. Well, thanks for your time, Adrian. Thanks for the effort to come up to the studio. It's good
Absolutely.
to see you, and no doubt I'll see you around the traps. Thanks for tuning, everyone. smartpropertyinvestment.com.au, where you can go to find more info. There's heaps of stuff around planning and strategies and all that sort of good stuff. Social media, Smart Property HQ, Instagram, Smart Property Investment. You can track us down there, like us, follow us, enjoy the content. Please, those reviews, keep them coming. Get a real kick out of it and appreciate them. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.